Well, Chapter 19, we're going to cover learning objectives 1, 2, and 3 today. Then we're going to do the others, which are going to be the earnings per share calculations in another PowerPoint. So I'm dividing your packet into two groups. Then you also have some discussion of the general concepts that you need to know for the chapter, which we usually cover when we look at our outlines. What is restricted stock? So this is a discussion of what is the difference between restricted stock and awards and restricted stock. If you give an award, you actually award it in the name of the employee, but the employer usually doesn't release it to the employee yet. They actually put the name of the employee on it. And so you'd say, well, it's issued, but it's not considered issued because the employee will forfeit it if they don't abide by any of the restrictions. Usually it's related to their continued employment. So they can't do anything with it. And then when you have restricted stock units, then they don't even really put the name on the stock or do anything with it. They just say, you've got the right to get stock in the future as long as you stay with the company. So what I need for you to know here, though, is, as I said previously, it doesn't show up in common stock until actually it vests or they have the right to actually have it. It shows up in a paid-in capital stock, a paid-in capital account, and if it's an RSU, it'll be paid-in capital RSUs. If it's restricted stock, it'll say paid-in capital restricted stock awards. So there's no liability recorded with this at all, and that's pretty much the way it is when we talk about this type of compensation. You don't accrue any type of liability. Instead, it accumulates in these paid-in capital accounts. So it's a part of contributed capital that accumulates. And then at the end of the time, when they have continued working, the ones who are left with our company will actually get the stock. If it lapses, you're going to just reclassify it to another caption. It's going to still stay in contributed capital. You're just going to say forfeit it. You know, it's still a part of that. You don't go back and change your amount of compensation. Compensation cost for either is the fair value of the restricted stock at the grant date, and it's equal to the market price of what's trading out there. Says you should accrue it to compensation expense, but I hesitate to use the word accrual because usually when we talk about accrual, we're talking about creating liabilities again. You are actually growing your contributed capital, paid-in capital for these awards. Restricted stock unit problem here, then we have a dollar par on these. That's not relevant. What's relevant is the market price on the date of the grant of these restricted stock units. And the market price on the stock on those days is $10, and there's 16 million, which is the number of shares that are represented by it. Now, on all of these problems, make sure when it says you have restricted stock units, it says restricted stock units, give them to write or to purchase one by one for one. So one restricted stock unit means one share. Because you get into difficulties. For example, when we get into options, it might say one option gives you the right to have 2 shares of stock. So you have to watch that. I try to keep it matched up equally in the problems. In this case, it's 160 million, then our total compensation. You would spread that equally over a 4-year period. Another thing which you're going to see in the journal entries is they tend to make it sound as if you're doing one journal entry at the end of the year. That is not the way it's done. You need to make sure that you, as I said, accrue or put a little bit in each time period if you're doing quarterly statements. So, and if you're doing monthly statements, you would do 1/12 of the full amount they say for the year. Has a restricted stock award plan to vice presidents. They grant 16 million of its $1 par common stock subject to forfeiture if terminated within 2 years. On this problem, it gives you the 2 years. Again, my caution is don't subtract say December 31st from the previous January 1st, and say that is for 1 year. Don't just look at the dates. Okay, think about it in terms of a calendar to figure out your years if they give you dates. Common shares have a market price of $5. That's the appropriate way to do this. Number of shares was granted 16. There you see your calculation. You should get 80. The 80 needs to be spread over 2 years, which case you would have compensation expense and paid-in capital, which is accumulating. So the compensation expense is going to income statement, and the paid-in capital is accumulating. Don't do it on December 31st. If you have quarterly, you need to do this every 3 months. You do 1/4 of that, or 10 million every quarter. If you do it monthly, if you're filing or preparing monthly financials, you need to properly allocate 1/12 of the 40 to each month. So I would liken this to a sort of a straight line method, because you are spreading that compensation expense over the time between the grant and when the vesting. Now, the next journal entry that happens on December 31st, 2019, and I'm going to tell you this one is actually December 31st, 2019. You are removing the balance from paid-in capital restricted stock, and you need to show the stock as issued, because indeed it's issued. Now, this issued stock is going to be par times the number of shares. That shows up as 16 million. That should be a credit. There's formatting issues at McGraw-Hill. I don't know why, but there is, and I've tried to correct, and it always comes back to this. So this should be a credit for par times number of shares issued, just as if you'd issued it in the marketplace, right? There's a difference in the paid-in capital of excess par between this and if it was shares that was issued for cash. If these shares were issued for cash, we would have used today's market price minus par, right? Instead, you're not going to use the December 31st, 2019 market price. What price are we using? We are using actually the market price, the fair value per share, okay, which is up there. On what date? The date of the grant, minus par. So the 64, they say it's a plug or a remainder amount. It's actually the difference between the market price on the grant date and the par of the stock, but it's from the grant date. It's not today's date. Another thing I want you to think about here is, what are we doing? Well, we created a paid-in capital or a contributed capital account by giving this restricted stock to our employees. We created it. Then what do we do at the end of the time period when it vests? Well, we don't create an increase in total contributed capital. I have to be careful about this. We are really just reclassifying contributed capital from this paid-in capital restricted to common stock and paid-in capital in excess of par on that common stock. We are just reclassifying common stock, or reclassifying, contributed capital. So we create the equity as we go along, right, in 2018 and in 2019. And then at the end of 2019, we are reclassifying contributed capital into issued stock versus paid-in capital restricted stock. The same would be done if it was restricted stock units or if it was the actual restricted stock awards. The only thing different would be the paid-in capital RS or RSU caption. Here we have restricted stock units. So in this one, they won't get anything if they leave the company within 3 years. So they are going to have a market price out there on the date of the grant of $2.50. Remember to use always grant date. First thing, figure up your compensation cost. Second thing, allocate it to time periods. Again, Spiceland's a bit wrong in this problem because they want you to do one journal entry on December 31st, 2018, one journal entry 2019, and then there's a couple journal entries, I guess, on December 31st, 2020. The 2018 and 2019, you would have multiple journal entries because you need to spread the compensation expense over appropriate periods of time, quarters, month. Whenever you do your financials, you need to show some compensation expense that are related to these restricted stock units. You just have to do that. So they're saying one journal entry, you'd have multiple depending upon how you do your financials. And then at the end on December 31st, 2020, you're going to have to then issue those shares. Whether restricted stock units or restricted stock awards would be done the same thing. $2.50 times the 12 million is going to be the total amount of compensation cost to note, and that's 30 million. There's no entry done on the specific day of the grant. That's what they want us to know. If they ask you a date, and I'm like, well, technically it's 1 over 360 or 365 times 10 million, right? So I don't know. I'd say they're trying to bring home the point. There is no journal entry on the grant date. Does it show up someplace? You betcha it shows up. You're going to have it in your financials and the notes to the financials. It'll be disclosed. But there's no journal entry. Now, the compensation expense needs to go to paid-in capital, restricted stock units, restricted stock awards, whatever the caption should be. I think it should say RSU here, and they just say restricted stock. 10 keeps going in there every year until you reach the total of 30 million, at which point you have completely vested, they have completely vested, and you're going to turn around and issue the shares. Again, the paid-in capital in excess of par is going to be market minus par, but it's not going to be market at the date in which it's issued. It's going to be market at the date in which you granted. So that's a little bit different. Again, formatting issue here. I guess you can see common stock will be credited for par times the number of shares. Stock options. Let's start talking about stock options. Stock options are very, very interesting to me because I have done some research in this area, and I find that oftentimes the CEOs who have these stock options don't do anything with them. And I'm very confused about this because if I were a CEO and I was given a stock option, I would think as soon as the thing became in the money, which means the value market price was greater than my option price, the price at which I could exercise that to be $17. That's the option. The exercise price is the value that that particular CEO is going to have to pay for the stock. So as soon as I would see that I was going to be making some money, I would probably go out there and buy it at the cheap value. And then you know what I would do? I would probably diversify because I would not want to hold a lot of shares in one particular company. But I'd be clever about it. I would do it in a way that it wouldn't be obvious to people because there's a lot of disclosures with the CEOs and executives and trading in company stock. So the point I'm making is, why would a company have executives who are in the money, say 72 million? That means the difference between the current market price and their exercise price times the number of exercise shares they have is $72 million. So they have $72 million, and I'd say at risk, right? Because if stock price goes down, they lose, right? So why would an executive do that? And in fact, what we do when we do our research is say that this is an example of an overconfident CEO when they are irrational with their stock options. And we call it irrational. It's just irrational to do that. But I do see it. A stock option becomes worthless if the current stock price then for this one goes below 17, because they could buy it in the market, say, for 16. Why would they exercise an option and pay more than market price? And they wouldn't do that. They would just let those options expire. So the options have a time period in which they can be exercised, and that is the vesting date, and they have an expiration date. And up here they're telling us that they permit the executive to purchase 12 million of the company's common shares within the next 6 years. So after 6 years, they can't exercise it anymore. Their option is worthless. But they can only start exercising it. They can only start using the option on December 31st, 2020. So you have a vesting date, you have a grant date, and with these you have an expiration date. You are not going to use the $17 for the value of the option. That's the amount of cash they pay. The true value of the option is going to be the difference between the market price on the day which they purchase and what they are going to pay for it. In this case, it's 17. So if the price of the stock went up to say, I don't know, $30, then it would be the difference between the 30 and 17, or the $13 they've made on that day, because they're only paying 17 for a $30 per share price of stock, right? So, but because of our time value of money, and we don't really know what the stock's value is going to be out there in the future, we have to use some sort of model that calculates it. And this is the Black-Scholes model. You can use other models. In 19.2, we'll discuss those. You can use other models, perfectly acceptable, but there are certain rules about the model. So most companies usually just use the Black-Scholes model. It's out there. You can buy programs that will calculate it for you. I'm pretty sure you could download a Excel macro that would do it for you. So it's just accepted. And so most companies don't even bother to come up with another model. They use the Black-Scholes model. And I'm not going to ask you to do the Black-Scholes model. Maybe if you're in finance, they made you do it. If you do that, you calculate it. In this particular case, they find it's $5 per option. And the options are granted are equal to the number of shares of which they get. So with options, sometimes you'll see one option is worth 2 shares. It just means when they do their pricing of each individual option, they need to note they're not getting 1 share at the end, they're getting 2. And when you do your journal entry to actually issue those shares, if they decide to exercise it, you need to remember you're giving out 2 shares and not 1 share per option. That's all it means. So the total amount compensation expense is going to be $60 million, and that has to be spread. So you got to have a model to come up with the value of this thing. And as long as it's a valid model that meets the criteria, which we're going to discuss in 19.2, then you're fine. Has to take into account the price of the option. So in this case it was 17. How long does it go? How long does it go out there until they actually it becomes worthless? The time period which it becomes vested. That also figures into this number 5, risk-free rate of return. That is time value of money. And then the expected volatility, because you're thinking about the spread between the market price when they exercise it and the exercise price, which is in the option. And that's where that comes in. Some stock also will earn a return in terms of dividends. So that's another benefit that actually goes into the model. Restricted stock units and forfeitures. This particular problem is very confusing. I'm not going to ask you to know a lot about it. And therefore, you could just say, write down in your SU8 packet the things I'm going to tell you. Here, they anticipate that 6% of the recipients are going to leave the firm prior to vesting. In your PowerPoints, we said that means you need to take 94% of whatever the value is of this restricted stock units. So instead of 100% for compensation expense, you're going to do 94%, and you're going to spread the 94% over the time period. What I just need you to know is that you do have an option to account for the forfeitures when they actually occur. And if you accounted for the forfeitures when they actually occur, then what you're going to do is you're going to have to adjust from the 100%. In this case, they say it's actually 5%, which they see. You're just going to have to note that the total that you need in paid in capital, just like we did in our PowerPoints, needs to be 95%. And as soon as you are aware that it's changed, you need to go back to the PowerPoint and you need to work the problem the way we would do in the PowerPoint. And that is to say, where do I need to be with paid in capital when it vests? Therefore, I need to be a certain fraction of it at the end of this year. And that's the way you work the problem. So, again, if I were working this problem, I would not probably take this option to account for forfeitures when they actually occur. If I anticipated 6% would leave the firm prior to vesting, my first journal entry when I started doing compensation expense would be based on that 94% and not the total. In this case, I would take not 360 million and attempt to spread it over the 3 years, but I would take 94% of the 360 million and spread it. And then when I see things have changed, I would do a journal entry. So I just like for you to just note those things and ignore this problem, but I wanted to include it because I wanted you to see that they do have the option to account for them when they actually occur. And if you look at this problem in here, just to reiterate again, you need to say, where do I need to be? I need to be at 95% of the 360. If you didn't do it at 90, what I say, 94% in the middle, but in the beginning, but we're starting to take 100% of the 360 and spread it. If you did it that way, if you need to make an adjustment to an estimate, if you're making an adjustment to an estimate, or you are actually noting that the forfeitures change and you're not even doing an estimate but just doing the actual, what you need to do is say, where do I need to be at the end and where am I today? Here they're thinking at the end, it's going to be 5% that's going to forfeit. Then I need to have 95% of 360, which is what they're talking about here, and I need to have 2/3 of it in paid in capital. And what have I got in there? That's the 120. And the next year they're saying, hey, where do I need to be? My total amount, again, needs to be 95% of 360. So, and this is 100% of that because it's the end of the 2020. And what do I have in there? So what do I need to put in there to make it right? So again, when you're doing adjustments and things change with this equity compensation, don't go off of spreading the difference over the future time periods. Instead, say, what do I need to have in paid in capital? So what's driving these journal entries is you saying, what is my balance in paid in capital need to be? And then the compensation expense is a plug. I suggest instead of working through this problem, you go back to your PowerPoints and you look at that problem where we had a change in estimate. And then the other thing with this, of course, is that you get the option of accounting for them actually when they occur versus doing your estimate. All right, this next problem, a variety of different compensation plans, and they have stock options here. It says no forfeitures are anticipated. What they mean then is that you should do it for the full value. The total compensation cost is going to be the option pricing model value times the number of options, and this is going to be 12 million. What is a journal entry when they're awarded? I guess you would not really, again, that's what they mean to be in the question too, the way they word it seems to be what is the amount of compensation expense for this particular day. And of course, for a particular day is 1 over 360 times the value, right? So, or 1 over 365 times the value, whichever you prefer. So technically that would have been the amount for 2, and there would have been a journal entry. I think what they're asking is, do you do a journal entry on the grant date? And that's no. Then on 3 and 4, these journal entries are going to be equal, and they are going to reflect the spreading of the options over the time period, which is 6 each time. So your paid-in capital is going to grow. Your paid-in capital is going to grow by $6 million each time, in which case you will have paid-in capital stocks options for $12 million. Now, I'll go on with this a little bit and say what happens then. You've got a total of $12 million in there. If they exercise it, you're going to take it out of stock options paid-in capital, and you're going to see issued stock. If they don't exercise it, you are going to transfer it to another caption and keep it in there as paid-in capital stock options, and you are going to say its stock options are expired for this new caption. Now, the other thing I think is very important in this whole discussion of compensation expense that relates to equity is that you have equity accounts that are accumulated. They're actually being created as they accumulate throughout the year after they are granted. Between granting and vesting, you have a contributed capital account that's growing. Could be paid-in capital stock options, could be paid-in capital RSUs, it could be paid-in capital restricted stock awards. The point is it's growing and you are creating contributed capital. What happens when this is actually converted into equity? It's still contributed capital. So basically you are just reclassifying at the point at which it vests. And it doesn't even matter whether they actually get the shares or not. So if they were to have these options and they do not exercise the options, you just keep it in contributed capital. You don't go back and change compensation expense for past periods of time. You just reclassify and say it's paid-in capital stock options, which have been forfeited because they are no longer valid because it's gone past the date at which they can be exercised. If you have graded vesting, let's talk about what graded vesting is. Graded vesting means they don't get all of it at a certain point in time. They only get a fraction of the shares. In this case, there's 400,000 stock options, and as I said before, make sure when it says number of stock options that the number of shares is the same. So in this case, one option is worth 1 share. So 400,000 shares, they could actually have access to 100,000 shares in December 2018, another 100,000 in 2019, another 100,000 on 2020, and December 31st of 2020, and the last 100,000 of that 400,000 on December 31st of 2021. Notice that the fair value per option, which is calculated according to BS, is going to be different. It's going to be different because on December 31st, 2018, you would anticipate stock price to be lower than on December 31st, say 2021. There's also the time value of money calculation, which gets back to the risk-free return rate. So there are several things happening here which cause the fair value options to be different. The appropriate way in which I did it within the PowerPoints, this is the problem is going to show you that there are a number of different ways. The way that I prefer and the way that I is what is within the PowerPoint, and that is to say that the total value of the December 31st, 2018 vesting amounts would be 100,000 times 350. 2019 would be 100,000 times 4, 2020 would be 100,000 times 450, and 2021 would be 100,000 times 5. And if you were to take those numbers and you were to add them all up, you would find that the total amount of compensation cost, if you did it this way, would be 1.7 million. Now, if you do that, and you put it into the tranches and you account for each one of those separately, The 2018, which is a 350,000, needs to show up as a part of compensation expense in 2018. The 400,000 needs to show up as compensation expense over 2018 and 2019, and so forth and so forth. And so the last group, which does not vest till December 31st, 2021, it has to be spread over, the 500,000 needs to be spread over how many years? 4 years. Now, if you did that method, you would come up with something that looks like this in terms of a table. So we are spreading those over the periods of time, which means the compensation expense, which you record in 2018, would be 825,000. Compensation for 2019, 475, etc. Until you get up to 1.7 total compensation expense, which has been spread over the 4 periods of time. All right, that's the way I would work it. That is absolutely the way I would do this problem. And one of the peculiar things, though, you see with it is that compensation expense will be greater in the first year, and it steadfastly goes down. So the effect on the financials will be a greater hit in the beginning than the end. So some people would prefer to take a straight line method. In that case, you take the 1.7 and you're going to divide it by 4, and you are going to take 425,000 per year. That's acceptable. But there is a rule that also kicks in that we're going to get into, and that is a company must have expensed at least the amount, the cumulative amount that is vested at that date. So you're going to go off cumulatives. So if you go up here and you look at the table we created initially, we know that at 2018, the total amount which could vest is going to be 350,000. We know that in December 31st, 2019, the total amount which would vest would be the 350,000 plus the 400,000, etc. So that by the time you get to December 31st, 2021, you'll have the total 1.7 vested. So in December 31st, 2021, the total amount which you should have taken to expense by the end of that period of time would have been, from January 1st, 2018 through December 31st, 2021, the total amount which you need to show up in your financials in your expense category needs to be 1.7. Also going back to 2018, you need to have at least 350,000 as expense for 2018 because that's the amount that would have vested on that date. And again, they have 825 hitting. So if you do a schedule like this, it's highly likely that you'll meet that requirement every time. The other methods, you might not. But you do need to go through and make the calculations. So if you do this, you're going to make those comparisons. That's what requirement 2 is. It's going to tell you if you're right to do it. So there's a constraint that you have to meet. You can also use an overall value of your stock options and do it that way. So don't price each one separately, but do a weighted average and apply it. If you were to do this, I'm not going to ask you to do this calculation ever. I just need you to know that it's a possibility that you could do this. You can use this one value and calculate it based upon the one value. The one value, weighted average value they come up with is $4.50, which is an average of the 4 stock option values. If you do this, then you can go in and you can allocate it this way over a vesting period. Or again, you could do it straight line. Still, we have that same requirement though, comparing it to the cumulative compensation expense must be compared to cumulative vested amounts. Employee share purchases. Employee share purchases, if they're a minor amount, they do not show up as compensation expense. So Walmart did this, Tandy Corporation did this, some companies do this. What they want to do is they want to encourage the company to employees to feel a part of the company. They want them to feel camaraderie. They want them to feel that what they do matters. And so they're trying to get the loyalty, the employee loyalty to the company. And one way they do it is to say that you matter to us, stock price is affected by what you do, and we're going to let you buy our stock at a discount. If the discount is 5%, you don't record compensation expense. If the discount is greater than 5%, then you record compensation expense. And so this one, it says it's 15%. So you're going to say, okay, well then I record compensation expense for 5%, and the 10 I don't record as compensation expense. No, no. It's just all or nothing. So if you're at 15%, you need to take 15% of the stock value, the market price of the stock, and since they're not going to pay it in cash, you're going to record it as compensation expense. So when you do these journal entries, then your debit will be the value either of the cash which comes in, or the cash plus the compensation expense, and you record it accordingly. So let's just go into this. Some of these things, it's easier to just look at journal entries, isn't it? If it is 15%, the market price is $12, the number of shares is 50,000 shares, you are required to do a debit to compensation expense for that 15%. And the cash which comes in, you know, is going to be 85% because the 15% was their discount. So your total debits are going to be equal to 600,000, which is the market price. And when you record your credit, it's common stock times par, and then paid in capital, which is market minus par times number of shares. And that's fairly straightforward. Now, if you say gave your employees 1% discount on their purpose. Well, if you gave them a 1% discount, how much cash would you get in? You would get in the 600,000, which is the market price, minus 1%, which is 6,000, or you would get cash coming in of $594,000. Your debit would not be to compensation expense for that $6,000, because if it's under 5%, this is 1%, you would not do a debit for compensation expense. So now you have a debit, a total cash debit of $594,000. You're issuing the same 50,000 shares at $1 par, so your credit is going to be to 50,000. What do? You put a plug number in for paid-in capital. Now, I can explain the paid-in capital in this one. It is not market minus par times number of shares. What is it? It's market minus par times number of shares less the 1% discount of $6,000. So your paid-in capital in that case for your common stock would be $554,000. Confusing, isn't it? But that's the way we work that problem. So in this one, it's just a description of the stock purchase plan, and you have to describe a lot of the stuff in the notes. And I'm going to skip this problem because I don't agree with it. So we are going to skip it, other than that you note that this stock purchase plan is quite elaborate in the discussion of it, as is everything which has to do with equity compensation. So You can skip the way in which you work the problem. Okay, so the next area which we'll cover will be earnings per share, and we'll spend some time on discussing how to calculate weighted average, and we'll also talk about, so there's two parts to earnings per share that you need to pay attention when we get to the PowerPoints. That is the numerator and the denominator. And there are two earnings per share that we'll be talking about how we calculate. There is the basic, which is a simple calculation. You probably had that in Accounting 201. And then there's fully diluted. So we're going to have to cover both of those. But it's really fundamental that you understand how weighted average is calculated.